Hi guys, good evening and welcome to Money Control Markets Weekly. I'm Karunya Rao and joining me in conversation today is Sahil Kapoor from DSP Investment Managers. Sahil, great to have you on board. In fact, earlier this month you had released a report about the early warning and signals through the use of charts, of course. It had a lot of comparison of what's happening globally vis-a-vis back home in India, how the macro indicators are playing out in both the scenarios. But before we talk more in detail about this report, I want to understand what should one make of the recent rally that we saw in the market. Of course, this week was an exception where we saw markets retreating a tad. But is the strength, is the optimism, resilience, all that justified given that globally we're looking at fears of a recession and a slowdown?
Sure. Thank you for having me. And Karunya, I think it's a very valid question. Plus, I think there are a lot of doubt because we don't have a good parallel in history to look at what's happening right now. We only have a very short parallel. I think before the crisis in 2008 unfolded, there was a brief period when India was doing well while rest of the world was not doing so well, and that has been etched in memory of people who were in markets at that point in time, and it has led to a lot of participants comment that Indian performance is unjustified or it can get hit anytime. So I have two key takes on this question. First is that when you look at history, we of course don't have many parallels, so it's very difficult with to say with conviction that we are going to continue to diverge in performance and we are going to continue to do better. But the second and more important point is, what is the data saying? So data is saying two things. One, that our earnings growth is much better than the peer set. When you look at emerging markets other than India, there are many emerging markets where 10-15 year earnings growth is absolutely zero or in low single digits. Versus when you look at India, we have earnings growth. So that is supportive. And secondly, our macroeconomic indicators, which show the resilience of the Indian economy or the steady performance of the Indian economy, they are yet to give up any strength. So they are still steady, they're still doing well. So I expect Indian markets to continue to do well. It will have its own pocket of up and down movement, but on a steady state, I think we are in a long-term bull market.
Right. In fact, I want to highlight what you have mentioned in this report as well, that earnings have been supportive so far. But going forward, what is the visibility we have? Because if commodities will once again bounce back, oil, of course, is it could be a big dampener if it rebounds. There are fears of a slowdown and a recession in markets like US, and typically with a lag, it could impact India Inc. as well. So, do you see some pain at least in the next 1 year and then things settling down meaningfully over the long haul?
Sure. So, Karunya, if you remember last time when we had a conversation, we discussed this split of earnings between exporters or companies which have their earnings more globally
Mm.
linked and then a part which is India linked. So, after COVID, everything which was linked globally did exceptionally well, whether it was commodities, metals, oil and gas, IT, and to some degree in the initial part, even pharmaceutical companies, all of them did really well, right? And now what we are seeing is that that global part is slowly and steadily and gradually it's losing the kind of shiny earnings growth that it had shown in the aftermath of COVID. But what's changing is the domestic part. Domestic companies which are more locally oriented. For example, I have spoken about this on Money Control earlier, that 38 to 40% of India's market cap is represented by what we call BFSI. That BFSI sector for the last 4 or 5 years before FY22 had shown very little by the way of earnings growth. Now we are witnessing that sector is making a comeback. It has a strong balance sheet, clean, credit growth trend, and it also have very, very strong asset quality. So I think overall we have a number of sectors, for example, BFSI, for example, domestic consumption in terms of durables like autos, two-wheelers, etc. Some domestic building material companies which are taking benefit from a resurging real estate cycle. So I think these sectors, on an aggregate level, more locally oriented sectors, are likely to take the mantle of earnings growth from the globally linked sectors. And therefore, on an aggregate basis, you will see that India's earning growth will be steady. We are not talking about hitting sixes out of the park. We are not talking about 20% earnings growth. And we are also not talking about the earnings growth in low single digits. We are saying that we will grow between 12 to 14%, which is good enough for our performance to continue.
How would you also explain the valuations for large caps specifically? Because if we look at your charts itself, it shows that we are almost on par with global peers and the valuations are pretty high.
Yes, I recollect about 3 months ago, I was writing that if Nifty was to go to levels of 16,500 to 17,000, you should be increasing your equity exposure. But last
Hmm.
about, I think, 60, 70 days, we've seen a 2,000 point rally on Nifty. And right now, if you put a new single rupee in the market, let's say on the Nifty, what you're buying is 22.3 times trailing earnings, which I don't think is materially cheap, right? So we are not in the expensive category, but we have left the average and cheap category behind right now, right? So we are not trading in a zone where you could easily make, let's say, a 15% CAGR over the next 2 years. So the large cap valuations on an aggregate basis have started to appear a little, let's say, I would say less cheap now or above average, right? Second thing and more important thing is that then you will have to do two things: move away from the headline valuation numbers, don't look at the Nifty valuation alone, and go to two things. One, you look at sectors where there is valuation comfort and earnings growth, and secondly, look at market cap cuts. Are mid and small caps cheaper than large caps? I think that is a question that you should answer when you look at large cap valuations. And there, I think there is a lot of play available, which will give you a lot more runway over the next 3 to 5 years in terms of timing. Plus, I think expensive valuation, they continue to go up and down. Uh, because if you visualize, our earnings are growing at a, let's say, a slow pace, uh, and the market is much more volatile. So, for example, if earnings are rising at 10, 12, 15% per annum, markets tend to go up 30% in 1 year and then fall maybe 5% the next year. So, it's a volatile cousin of earnings. So, right now, we are a little ahead of in terms of valuation. It can get corrected very quickly, as you know markets are much more volatile. So I'm not too worried about this picture, but yes, I would prefer to look at more mid and small cap stocks, or preferably more sectoral cuts than necessarily looking
Hmm.
only at Nifty earnings.
That's an interesting perspective because most people we've spoken to typically say that it's safer to lean towards the large caps vis-a-vis the mid and small cap. But of course, given the sustained underperformance that the broader markets have shown for the last 15, 16 months, would it be correct to say that the froth is gone and from these levels now they'll start picking up meaningfully?
It does appear to be the case. So in January this year, exactly 5th December 2021, we put
Hmm.
out a chart saying that the 2 year CAGR performance of mid and small cap indices are running at 22% to 26% alpha over Nifty, which is unsustainable. We have seen that these numbers don't last for a very long time, and it's time to be more aligned towards large caps in the year 2022. And the full year has gone, 12 months have passed, that froth has gone away. Now we see that there is an underperformance, rolling underperformance on a 2 year CAGR basis of about 10% or more in mid and small cap space. So the margin of safety has come back. Secondly, on a valuation, relative valuation basis, mid and small caps are at an aggregate level cheaper than large caps. And third and more important thing, that if and when the Indian growth is incrementally better than the rest of the world, domestically oriented businesses, which are generally smaller in nature, more MSME sort of businesses and mid and small cap businesses, they tend to perform a little better. So I think this is the case where possibly mid and small cap might give you a better investor journey in 2023. And second thing is, we should remember that Indian economy is now recovering. The part of the economy which has not recovered at all is the rural economy and the bottom of the pyramid economy. We have a K-shaped recovery.
Hmm.
That part, I think, is probably beginning to see some recovery, very short recovery. We have some commentators making these comments, and there is some very small data points now occurring which supports this view. So if that view is right, then again the smaller capitalization, the mid and small caps, should probably benefit more than the large caps.
So, what kind of themes would you place your bets on from the broader markets? Because we saw some momentum building up in IT space, but again, it kind of got reversed. Seemed more like a dead
Sure.
cat bounce in the IT space. Some names, the likes of Marico, Dabur, mid and small caps from the FMCG space, they also have been seeing a lot of traction. Then there are, a host of other sectors, small and large, where there is a lot of exposure to the broader markets. So, any pockets, any themes that you think could outperform?
So themes where we feel there is margin of safety, one of course on a larger theme when you look at is BFSI. I think there is a
Okay.
steady earnings trend there and it should continue to do well. So lenders of all shapes and sizes, whether we are talking about banks or specific NBFCs which are high quality in nature, plus also some insurance companies and other financial services companies. I think there is a lot of opportunity in this pocket. Second pocket, which is from a relative valuation basis, if I stack up all the sectors, then healthcare is one of the cheaper sectors in comparison to all other sectors. There, the margin of safety is much higher. That again, I think, is an opportunity which will probably deliver better returns over the next 3 to 5 years. And then, of course, you look at more domestically oriented sectors in auto, building, construction. For example, tiles manufacturer,
Hmm.
or from auto, you look at two-wheelers, four-wheeler companies, tractor companies. I think these are the sectors where we see there is a lot of opportunity and they will deliver. Another sector which I have spoken about in my recent report is the real estate sector. I think there has been a large deleveraging that has happened in this category. Plus, I think the cash flows are improving. And thirdly, most likely the market is not appreciating the fact that the way the business is done in this sector is turning around, it's changing.
Hmm.
So, these three factors also tell me that real estate again could be a good opportunity to look at from a sectoral perspective.
Okay, I see that you very conveniently ignored the question about IT. I
No,
want
I
to
will talk
circle
about
back
it.
to
Yes.
I
So,
want
I
to
think
circle
IT
back
is
to
a
that.
Yes, of course. I think so. IT, we've been very reluctant about IT in terms of how to look at it. Rather, I would say that we've been a little confused. And the
Hmm.
reason for that is that valuations have still not gone back to levels which will give us margin of safety. So that has not happened. Most of these large cap companies are still trading upwards of 30 times trailing earnings. And in past cycles, when the correction occurs, the margin of safety occurs somewhere close to 20-25 times. So there is still on a historical basis, when you compare it to history, the valuations have not come back to that level. And secondly,
Hmm.
what we are witnessing is that the breakneck scorching growth that we've seen. Let me give you an aggregate number. So in the last 5 years, or 4 years to be precise, our overall software exports have grown at a CAGR of more than 15%. Okay, which is a
Okay.
very high pace. And I don't remember any particular phase other than one-off years when this 5 year CAGR number or 4 year CAGR number was at this pace. So I think this is a little unsustainable, the kind of pace that we've seen. So most of these companies most likely will consolidate, both in terms of their earnings and possibly in terms of valuations. So I think there are other companies which have done wonderfully well, and market probably will go and look at those companies. So just to give you one parallel, there is a large cap pharma company and there is a large cap IT company. Both these companies have delivered 15% EBITDA CAGR over the last 5 years, exactly 15%. But and other ratios are also very similar. But in case of the IT company, the market cap growth has been 28% CAGR, and in case of the pharma company, it's only 10% CAGR. So the market has
Hmm.
not really rewarded both the cash flows equally, I think these kind of mean reversions will occur. So possibly over the next 1 year or so, IT might be just in a consolidation phase or in a correction mode, but there are other sectors which I think will be more in focus.
Okay. What about new age stocks, new age tech companies, especially because they have eroded enormous amount of value for especially retail investors who've been wanting to ride that IPO tide from last year, but have ended up with very miserable losses. What is the lesson to learn here from all of these companies, and the kind of value erosion they have actually led to for investors?
So, Karunya, by structure or by elimination, we were lucky to have implemented the lessons of the past and not to have invested in most of these companies or any of these IPOs, to be very frank. And the problem with new age businesses, so to speak, is that we don't see the path to profitability in many of these companies. And when we talk about these companies, I go back to a quote I read in one of the books that I was reading, where the semiconductor industry of 1980s was being discussed, and there the author says about a specific company um, which created photolithography, which is a very important technique, where he says that the company's management focus was more on the Wall Street than on R&D. And that
Hmm.
decade was a very tough decade for the semiconductor industry. It had a huge amount of ups and downs. So I think this is what we're looking at in terms of many of the new age businesses, where I think the path to profitability is still not clear. So we are still steering clear of many of these names, and there are one or two businesses where we feel that there is a real chance of value emerging once the correction occurs or prices become more attractive. But I think we are still some time away from it.
Okay. So even though they are way below the issue price, you still think it's not a good idea to get tempted and dip in.
I think issue price should not be an anchor. We will have to value these companies basis bottoms up analysis on what kind of profitability that they can create. Because as you know, we have examples of, let alone stocks, we have example of sectors which are still 80% below
Hmm.
2007 peaks, right? So companies in itself, single stock prices in itself could be a different game altogether. So I don't think IPO price should be an anchor to look at.
Okay, very well said. But one sector, since you talked about the laggard, I want to talk about the star performer, PSU banks. They have done extremely well. I think in 2022, it's up more than 70% for the Nifty PSU Bank Index. Balance sheet growth, balance sheets, strength and overall growth has improved a fair bit for most public sector banks. Talk to us about your view there. Do you think this is something that is now going to play out as a meaningful theme after being dormant for all these years, or are you still staying clear of PSBs?
So on we are not very idealistic about staying away from PSBs, or so we have a number of these stocks in some of our strategies in some of our funds where we have participated really well over time. So on a let's say on a at a aggregate strategy level, that is not something that we do in all our funds or not do in all our funds. So it's a very uh, fund specific call. It's a very fund
Hmm.
manager specific call to take. Secondly, from a business perspective, I think there have been tailwinds for these companies, particularly one that, as you said, balance sheets have seen an improvement. Second, credit growth has made a comeback. Third, and more important point is that the starting valuation for the sector was dirt cheap. So all
Yeah.
these factors have really helped, PSU banks perform really well. Second thing and more important thing is, what is the structural story here? I think that structural story probably is still, it favors the private space, because private banks are still gaining market share. Even whatever returns that we see in the stock market, private banks are still gaining market share at the cost of PSU banks. their profitability is still better. Uh, so I would say that there are two or three top PSU banks where we continue to remain active, and we continue to scout for opportunities. So we don't paint all of them necessarily with the same brush. But many of these banks, the PSB specifically, are more tactical bets in nature rather than buy and hold long term 5 to 10 year kind of a story. So A, we are
Okay.
more tactical in this space. B, we are very very stock specific.
Okay. Well, we're almost at the end of 2022, but going into 2023, what will be the big learnings from this year? Like, you started off by saying that this year, and I'm sure most of us will agree that it has been an unprecedented year. The kind of events we witnessed, the kind of volatility and moves we've seen across different asset classes. So, what will be your biggest learning from the year gone by, from 2022?
So in most years, I think one of the earnings get reinforced is do nothing. So even when I was analyzing, let's say 2021, and asked myself that what different could I have done to have a better outcome. And when you just look at the indices between 2020 and 21 and 22, many investors, maybe most of us, if they had done nothing at all, they would have come out very, very well. Even in 22, with all the volatility that you've seen, if you were a normal flexi cap or a large cap investor, you would have done really well by not doing anything in 2022. So I think for most volatile years, either being very, very systematic and just investing every month makes a lot of sense, or doing nothing makes a lot of sense. But my guess is that in 2023, some activity in terms of rejigging your focus towards market capitalization, or rejigging your focus towards sectors and themes where there is more margin of safety, I think that should do well. And second thing is that we should remember that we are still in the early phase of growth for Indian economy in this cycle. So most likely this cycle will run for a few more years, and a little bit of optimism will be helpful. Of course, with a dose of skepticism for the valuation, for the price that you pay for each stock. So I think this is the lesson that I will take from 22 to 23.
All right, and we will look forward to what DSP has in store for 2023, what the strategy will be, and we will touch base then. But that's all for now and for today. Thank you so much, Sahil, for joining in and for sharing your observations, your learnings, and your thoughts on the market with us and our viewers.
Thank you very much.